All right, so how do multifamily deals get in trouble? You may be familiar with this deal, 3,200 units in Houston, Texas, that recently got in trouble, lost over $200 million of loans, and basically went for foreclosed on those. What really separates a great multifamily deal from one that's really struggling? We're going to jump into it now. We're seeing in our multifamily deals, we're seeing deals that were performing very, very well due to higher costs in interest rates, higher costs in expenses and labor and insurance, that a lot of the cash flow is not quite what it was 6 to 12 or 18 months ago. So we're going to jump into why a multifamily deal gets in trouble and what you can do to prevent it. So let's jump in and go for it. All right, my name is Bronson Hill. I'm the CEO of Bronson Equity. We've got over 200 million multifamily apartments. We also do some alternative assets such as ATMs, car washes, and oil and gas. I'm not your investment advisor. These are just my opinions to get your own advice on financial matters. So let's talk about the present danger, right? We're seeing a great cash flow. It's been a golden age of multifamily for a long time. We've seen just really, really great cash flow for a while until March of 2022. If you remember what happened, the Fed started raising interest rates, and they've raised them from almost 0% to around 5%, 5 to 5.25 the time of recording this. And it's been one of the fastest increases in interest rates we've ever seen. And so we're seeing that really affect a lot of multifamily deals, commercial deals, particularly those with bridge debt. And you say, well, why would people have bridge debt? Well, we'll get into that here in a minute. But about 80% of commercial loans are with bridge debt, similar in multifamily. And so we're seeing that as rates rise, it's causing some pain in the multifamily space because the interest costs are costing more. Even if you have a cap on that rate, it's still costing more than it did before, and it's affecting valuations as well. So let's just talk about that for a minute. Why would people do bridge debt, right? Why would that happen? Well, for a while, it was deals that would only work with bridge debt. That's what people were doing. And if everybody else was doing bridge debt, people weren't doing fixed rate because the fixed rate didn't work. You had to put too much money down. The numbers didn't quite make sense, right? And so they found a way to say, hey, if rates stay this low, and again, we've had just a period of about 8 or 10 years where bridge debt has actually worked out pretty well because rates have stayed low, they've gone lower, and it's just been, with bridge debt, it's worked out fine. Well, now it's gone the other way, and it's created a very painful situation for a lot of people. We're also seeing in our deals, particularly in Florida, we're seeing higher costs, we're seeing higher labor costs, typically 30 to 50% higher on labor as well as materials. So we're seeing some of the material costs have come down. We're seeing a higher cost. We're also seeing that insurance cost has gone up 3 to 4 times higher in Florida. Well, of course, because these hurricanes, so it causes higher expenses. So again, we're seeing higher expenses, but we're not necessarily seeing higher income. We're seeing a little bit, rents are kind of stabilized, or maybe they're slightly up, slightly down, but they're pretty stable. But the costs are going up. So what's happened to the cash flow, we've seen all these deals that were cash flowing really well have started to kind of squeeze on the cash flow due to interest costs, expenses, and income hasn't really risen that much. So what's going on here, right? What's really happening, and how does a multifamily deal get in trouble? So again, there's just standard ways of this is happening to most people across the board, and so we're seeing it. And so really what's happened is there's a huge distinction between good operators and poor operators. My good friend Ken McElroy says this. He says 2023 is the year of operations, and he's talking about multifamily operators. If you are a good operator and you can come in and you can operate a deal really well, then you're going to do just fine. You're going to weather the storm. It's not going to be that big of a deal because you were conservative on your projections. You're able to do the plan you set forth, and you're able to communicate well with investors. It's going to go well, right? So what do good operators do, right? Well, they go after something that's in their wheelhouse. Typically, they've done multiple deals in those markets. They have a great team. I've seen sometimes good operators go to other markets and not be as good, but in a particular market, it's in their wheelhouse. They've shown they can do it. Often too, we'll see a lot of great operators are wonderful at communication, right? They're great at communicating with their investors. They're great at communicating with their tenants. You see really, really good communication. And then a lot of times they'll go after value add stuff. And I use this term value add. You maybe say, well, what do you mean by value add? Well, I mean basically not taking a brand new property, not new construction, because if you develop something, you do new construction, you've typically got a 2 to 3 year window before that property is actually fully in operations, right? So if you're able to come to something that is a little bit older or has some work that needs to be done, you can come in and bring some renovations to that property. You're gonna see the rents rise. That provides an additional margin of safety. So Warren Buffett talks about this term, margin of safety. That just means if things don't go exactly the way you want, are you still able to make money? Are you still able to have some margin there? And that's what great operators do. So poor operators, it's just the opposite. There's typically poor communication, there's poor responses, there's excuses. They're really not operating according to the plan, right? They have great ideas, but they're not actually able to operate it. So if for that reason, deals usually will struggle and some will even be lost, right? So watching out for operators that don't have a track record, that don't communicate well, their reputation is not great. And this is for a lot of new investors. They don't realize that, well, how do I separate good and poor operators? Well, reputation is huge. It's good talking with other investors, talking with other people. We'll give you other information about this group. So really at this point, so after sharing all this, we see the present danger, right? We see good operators, poor operators. So how should we look at multifamily, right? Well, there's two ways really that I see right now to look at multifamily. You could look at it one way and say, well, there's just great challenges. And, I don't know, multifamily is just not looking that great anymore. It's not the right time. I don't have cash on the sidelines. Lending has slowed down, which is true. We have about 80% less transactions getting done in large multifamily over the last 12 to 18 months. So we're seeing a significant reduction in the number of deals. We're just not seeing as many deals that are done. So a lot of people want to say, let's just sit here, let's hoard cash, let's wait and see. We've actually, we're operating what we have, and then we also have our other stuff. We have our oil and gas, our ATMs, our car washes, other cash flowing type of deals. I don't like to have personally money on the sidelines just sitting there because you're losing money to inflation much, much higher than the official rate. I think probably around 15% or so. But again, that's a much higher figure than what the official inflation figure is. So that's one way to look at it. The other one is really, instead of a great challenge or just a great crisis, you can look at it as a great opportunity. Well, what is the opportunity here? Well, we know that in multifamily, there's a huge shortage. In the studies that come out that show we're short typically 3 to 8 million housing units or 3 to 8 million apartment units. It's been consistent over the last few years. We're just seeing a great demand because of population shifts, population growth for more apartment buildings. And so, and this is really my opinion here, is that rates will rise. They're going to stay high for a bit, and then they're going to go lower because the primary reason, the federal government cannot keep the rates too high. And you can see on the chart here, we're over 32 trillion now above on our national debt. At 5% per year, that means it's 1.5 trillion in interest costs if we're paying 5%. I think some of these loans are longer term or shorter term. So we're basically getting to a place where the interest cost is going higher and higher. We're also running more deficits where that's getting higher and higher. And again, we just can't have a spiraling national deficit. So if rates stay high for a long time, I think Paul Volcker had said before he passed away, which was the Fed chairman who took rates to 20% in 1980, that he would not be able to do it in the current environment because we have so much debt. So as much as Jay Powell wants to be Paul Volcker and do all these amazing things and raise rates and reduce inflation, it's going to be very, very difficult to do. So I would say in general, look for value add deals, look for a long-term focus, know that there is an inflation hedge with multifamily, there's tax benefits and other things. And it may be for you that, hey, like us, we're saying, hey, we're looking for deals. We're also saying, we're going to wait for the right deal, right? So we're doing other things. We're also waiting for the right deal. And then when the right deal opens up and it makes sense, we're getting better pricing, we're getting better opportunities, we're going to go for that. So multifamily is great. Just in conclusion, I love multifamily. I'm a big multifamily guy, but get ready for things to change. If you're feeling the pinch in cash flow in a deal, that's okay. But just remember to keep looking long term. A lot of these deals that, even if the cash flow is a little lower, as long as the deal is able to be maintained, there should be a good long-term outlook with a good operator. So wanted to share this quote with you that I like about investing in yourself. It says, "It's never a waste of time or money to invest in yourself, no matter the source. True wealth begins inward and emits its light outward into everything else, including the people you surround yourself with." It's by Will.i.am. And I think that's so true. If you just surround yourself with the right people, you invest in yourself. I got my little invest in yourself sign up here, and I so believe in that. I spend a lot of money, tens of thousands of dollars a year, just investing in myself, going to conferences, events, masterminds, coaching, all these things, because I want to get better. And so whatever that looks like for you, I encourage you to read books, go to events, just continue to develop yourself as an investor. So I want to share this with you. This is this video I did. It's called Think Rich, Grow Rich. And it basically is just, changing your mindset to a wealth mindset. There's some really innovative things in there, getting some good feedback on that. Check that out. And then if you haven't joined our investor club, again, we're doing some unique things outside of real estate right now. We have our multifamily deals, our oil and gas. We've got our ATM machine fund and our car wash fund. Seeing some great stuff there. So check that out in the link below. Share and like this video. Follow us, subscribe to hear the newest videos that are coming out. And we look forward to seeing you on the next video.